I have watched people misunderstand wealth my entire life. They think wealth is built by brilliance in the middle of a panic. They think the man who wins during a collapse is the man with the fastest hands, the sharpest prediction, the hottest tip, the nerve to press the button while everyone else is frozen. That is not what I have seen. It is not what I have done, and it is not how serious fortunes are built. The truth is plainer than that, and because it is plain, most people miss it. The men and women who build lasting fortunes in economic collapses do not react to the crash. They arrive with a shopping list already written. They have already decided what counts as cash, what counts as collateral, what counts as ownership, what counts as productive ground, what counts as permanent demand, and what counts as a story designed to distract the crowd while real assets are quietly changing hands. That is the difference. Most people enter a downturn hoping to survive it. A very small minority enter a downturn prepared to buy it. That difference sounds small when you hear it said quickly. In real life, it is the difference between spending the next 10 years trying to get back to even and spending the next 10 years sitting on assets you bought when everybody else was selling in pain. I want you to understand something before I go any further. I am not talking about guessing the exact date of a crash. I am not talking about acting like a prophet or pretending I know what headline lands on which Tuesday morning. Markets do not reward theater for very long. They reward structure. They reward people who understand what happens to human beings when credit tightens, when prices fall, when leverage breaks, when confidence evaporates, and when the same public that was calling itself disciplined a year earlier discovers that discipline was only confidence wearing a cheap suit. If you want to know how real money behaves before a major break, you do not start with speeches. You start with what money can hide inside. You look for the instruments that keep their shape when panic starts. You look for the claims that survive bankruptcy while common shareholders disappear. You look for the ground that still produces calories no matter what a central banker says on television. You look for scarcity that cannot be printed. You look for businesses whose customers do not get to opt out just because the economy turns ugly. That is the real shopping list. And once you see it, you begin to understand a hard truth that most people spend half a lifetime resisting. Economic collapses are not only destruction events, they are transfer events. They move assets from the unprepared to the prepared. They move ownership from weak hands to patient hands. They move productive things away from people who needed the next quarter to go right and toward people who were prepared for a year of everything going wrong. I learned that lesson very early. When I was younger, I thought intelligence was the edge. I thought the smartest man in the room would always win. Then I watched brilliant people with beautiful models get broken because they were right about value and wrong about timing. I watched average businessmen with less glamour and more cash buy extraordinary assets from those same brilliant people after the glamour was gone. It did not take me long to recognize which side of that trade I preferred. So if you want the mother line that ties this whole thing together, here it is before every major collapse. Serious wealth does not search for excitement. It builds a shopping list and waits for the siren. Everything else I am going to tell you hangs from that line. The first item on the real shopping list is what I call the ammunition principle. That principle sounds so boring that most people dismiss it before they understand it. They hear the phrase short-term treasury bills, cash equivalents, dry powder, and their eyes glaze over. They have been trained to think cash is laziness. They have been told that if money is not swinging at a pitch every second of the day, it is being wasted. They confuse being fully invested with being fully intelligent. That is one of the costliest confusions in finance. Cash, or anything that behaves like cash with virtually no credit risk and minimal duration risk, is not dead money when the world is overpriced. It is stored command. It is future buying power kept intact for the moment. When everyone around you loses theirs, it is not exciting during the party. it becomes decisive when the party turns into an evacuation. I have seen people laugh at large cash balances for years and then beg for them 6 months later. They say, "But Warren, cash yields less than stocks in the long run." That is true in the wrong conversation. The right conversation is not whether cash beats a bull market. The right conversation is whether cash gives you the ability to buy an outstanding business, a durable security, or a productive asset at half price when other people are forced to liquidate. The answer to that question has never changed. A crash requires sellers. Sellers require buyers. Buyers require cash. If you do not arrive with cash, you are not a buyer in a crisis. You are part of the scenery. That is why the ammunition principle matters so much. It changes your role. It takes you from spectator to acquirer. I have watched men spend years worshiping full exposure and then discover at exactly the wrong moment that they had built no reserve at all. Their portfolio looked diversified on a spreadsheet. In reality, it was a collection of things that all needed confidence, liquidity, and rising multiples to look intelligent. When those three supports vanished, so did their flexibility. Flexibility is one of the least celebrated and most valuable financial assets on earth. A portfolio that gives you no room to act is not a portfolio. It is a cage. Ammunition does two things at once. First, it preserves nominal value while others are being cut down. If you are sitting in short paper and very safe liquidity instruments, while overround assets are falling 30, 40, 50%, you may not feel heroic in the first phase, but you are not bleeding out with the crowd. That matters. Second, and much more important, ammunition gives you optionality. It lets you move from defense to offense without asking permission from the market. You do not need a rebound to save you. You do not need a central bank to rescue your portfolio. You can act because you still possess the one asset that turns into every other asset at the moment of distress. That is why smart money never talks about cash the way small money talks about cash. Small money sees cash as a return problem. Serious money sees cash as a timing weapon. If I have $10 million in short paper when wonderful businesses are selling at absurd discounts, I am not behind. I am armed. The second item on the real shopping list is what I call the claim conversion rule. This is where the crowd usually loses the plot completely, because the public has been taught to look at equity first. Ordinary investors are trained to think like shoppers of stock symbols. They see the world through price charts and ticker tape. But in a true corporate breakdown, equity is often the least interesting claim in the capital structure. The claim that matters is often above it. When a company is healthy, most people do not spend much time thinking about the waterfall of claims. They own the stock. They hope earnings grow, and they assume the future will reward them. During distress, that fantasy ends. Bankruptcy is not simply a business failure. It is a legal sorting machine. It tells you who truly owned a claim on the enterprise and who was merely renting optimism. The claim conversion rule is simple to state and difficult for the public to internalize. In a collapse, debt bought cheaply can become ownership more effectively than equity bought dearly ever could. That is why distressed debt has created some of the largest fortunes in modern finance. The public sees a company in trouble and assumes the whole thing is poison. The sophisticated buyer asks a better question: who gets paid first? Who sits above the common shareholder? What assets still exist? What cash flow remains? What contracts remain? What real estate remains? What logistics remain? What customer relationships remain? And at what fraction of replacement value can I buy the legal claim that will sit in the front of the line when this gets reorganized? That is not a stock market question. It is an ownership question. If a bond issued at par is trading at 20 cents on the dollar because the public is pricing in a funeral, The buyer who understands the capital stack may not be buying a dying security. He may be buying the right to emerge on the other side as the new owner after the old equity is erased. That is what ordinary people rarely understand. Distressed debt is not simply a bet on survival. Very often it is a method of conversion. You buy a broken claim, the court system wipes out weaker claims. The broken claim turns into equity in the reorganized business. You did not chase a hot stock. You bought your way into ownership through a legal door the public was too frightened or too uninformed to use. That is why I have always respected people who understood distress, even if I did not always choose to play in every corner of that field myself. They understood something fundamental about capitalism that polite conversation usually tries to hide. In a crisis, ownership migrates through legal structure, not emotional narrative, and there is a darker truth underneath it. Every distressed debt opportunity is built out of somebody else's emergency. A pension is threatened. Jobs disappear. Shareholders are wiped out. Managers who looked invincible 6 quarters earlier are begging lenders for time. I do not say that to moralize. I say it because if you are going to understand wealth honestly, you need to understand that the mechanism is not neutral. Productive assets do not vanish simply because public holders were ruined. They are transferred. The claim conversion rule is the machinery of that transfer. It takes chaos and turns it into title. It takes bankruptcy headlines and asks what still has value after the headlines are finished screaming. And if you learn to see that, you begin to stop thinking like someone who rents market opinions and start thinking like someone who buys legal priority. That is a profound identity shift. You move from ticker worshiper to claim analyst. You stop asking which stock is down the most. You start asking which claim will still matter when the common stock is ash. The third item on the shopping list is what I call the calorie floor. This is older than stock exchanges, older than central banking, older than most of the financial language people use to sound intelligent at dinner. Land that feeds people has a quality that almost no paper asset can match. It carries a floor beneath it that is not set by sentiment. It is set by necessity. People can delay vacations, they can cancel subscriptions, they can stop buying furniture, they do not stop needing food. That fact is so primitive that modern investors often overlook how powerful it is. Productive agricultural land is not simply dirt with a romantic story attached to it. It is productive capacity tied to biological demand. In periods when currencies are doubted, when financial assets are repriced, when urban speculation gets exposed, land that produces calories still stands on its own feet. I have seen people dismiss farmland because it lacks glamour. That is one of the reasons it has been such a durable place for real wealth. Glamour invites speculation, necessity invites endurance, and endurance is what matters in a real break. The calorie floor works because it rests on 3 supports. The first is biological demand. Human beings need to eat whether GDP is growing or shrinking. The demand may shift from steak to beans, from branded luxuries to staples, but calories remain non-negotiable. The second is asset finitude. Productive land is limited. Governments can change tax codes. Central banks can expand balance sheets. Venture capital can mint another 1,000 software claims in a year. None of that creates top-quality soil in the right location with access to infrastructure, water, and markets. The third is currency transcendence. The most resilient forms of farmland are often tied not just to local demand but to tradable output, exportable output, or goods that can be priced against broader markets. That matters because when a domestic currency weakens, an asset linked to broader demand can retain real value in a way purely domestic paper claims often cannot. That is why real land ownership has appeared again and again in long cycles of wealth preservation. Not because every acre is magical, not because all real estate is the same, but because productive ground sits closer to necessity than almost anything in modern portfolios. You do not need to mythologize it. You only need to understand what it is. It is a claim on calories. It is a claim on future output. It is a claim on something the population cannot vote away, and the central bank cannot print into existence. That is why quiet accumulators of farmland usually do not need to advertise what they are doing. The logic is too old to need promotion. The fourth item on the shopping list is what I call the scarcity ledger. Now we leave the farm and walk into a world that many ordinary investors misunderstand in the opposite direction. They assume blue, chip art, or similar finite cultural assets are toys for rich people. They assume these assets are about taste, status, or ego. Sometimes they are. But that is not the whole story, and it certainly is not the useful part of the story. When an asset has permanently fixed supply, deep collector demand, and weak correlation to listed markets, it begins to serve a very different role. It becomes a ledger of scarcity. The important feature is not aesthetic beauty. The important feature is that it cannot be manufactured when policymakers lose discipline. There is no central bank equivalent for a dead master or a culturally fixed work with institutional demand. Scarcity is not a marketing angle there. It is structural. Now, I am not telling ordinary people to run out and pretend to be art dealers. That would be foolish. This is a field where expertise, relationships, authenticity, provenance, and patience matter enormously. The average person can lose a great deal of money trying to imitate behavior. They only half understand. But if you want to understand how serious wealth behaves before a major dislocation, you should understand why the scarcity ledger exists. Paper systems are expandable. True scarcity is not. And when paper systems are stretched too far, scarce things with cultural legitimacy begin to function as preservation vehicles. There is another reason this category matters. Opacity public markets mark everything every second. They expose emotion in real time. They invite panic because they make panic tradable. Private treaty markets do not behave that way. They move more slowly. They negotiate. They do not put every fluctuation on a screen for frightened people to stare at all afternoon. That slower structure is not always superior, but in periods of stress, it can preserve pricing power because there is no forced spectacle around every move. Once again, the crowd and the prepared are playing different games. The crowd lives in public marks and instant emotion. The prepared often prefer scarcity with slower price discovery. That does not make the asset morally superior. It makes its behavior different. And in a period when correlations rise, different behavior becomes valuable all by itself. The fifth and final item on the shopping list is what I call the monopoly of necessity. This is the item that reveals the whole structure most clearly, because it is not just defense, it is offense. It is not only about preserving wealth, it is about building it rapidly during the very period that destroys weaker participants. The monopoly of necessity lives in businesses that remain unavoidable when times get hard. Waste collection storage, funeral services, pest control, water treatment, medical waste handling, certain maintenance services, certain infrastructure services, certain ugly, unglamorous, deeply practical businesses the public ignores because they do not come with a glamorous narrative. Those businesses are often underloved in good times because they do not promise transcendence. They promise continuity. That is exactly why they become so interesting in bad times. Demand does not disappear. Garbage still gets collected. People still need somewhere to store their lives after a forced move. Pipes still need repair. Infestations still arrive. The dead still require burial. Hospitals still need regulated disposal. And here is where the machine becomes brutally efficient. During a downturn, the smaller operators in those fields are often levered. Fragmented and badly financed, their customers still exist, but the operators themselves are vulnerable. Their borrowing costs rise, their refinancing options narrow, their margins get squeezed. Some fail, some become desperate sellers. The better capitalized buyer arrives with patience and balance sheet strength. He buys routes, he buys contracts, he buys local monopolies, he buys physical equipment, he buys customer lists, he buys the boring cash machine no one wanted to discuss at a growth conference. When the economy normalizes, he owns a larger share of an essential service category that never really stopped producing cash in the first place. That is how new fortunes are built during contraction, not by chasing what was glamorous in the boom, by buying what remains necessary in the bust. That is one of the deepest truths in finance. The public overpays for possibility and underprices inevitability. The monopoly of necessity is inevitability with a cash register attached. That is why it tends to look dull before the trouble starts, and that is why it looks brilliant after the trouble has done its work. Now, I want you to notice what ties these 5 lines together. The ammunition principle gives you the means to act. The claim conversion rule gives you a method to turn distress into ownership. The calorie floor gives you productive capacity tied to biological demand. The scarcity ledger gives you fixed supply outside the printing press. The monopoly of necessity gives you durable cash flow when glamour is being liquidated. Different assets, same logic. They all sit closer to structure than to story, and that is what people miss. The average investor is trained to think in stories, hot sectors, narratives, themes, great founders, big platforms, exploding TAMs. Next decade winners. He is rarely trained to think in structure, priority of claim, duration of liquidity, biological demand, supply rigidity, inelastic usage, forced selling, legal conversion, replacement cost. That is why crashes feel random to him. They are not random, they are structured. What feels like chaos at the headline level often becomes astonishingly legible once you understand the shopping list used by people who prepare instead of react. That does not mean every cycle is identical. It means the human behavior inside the cycle is identical, often enough to matter enormously. People stretch for yield. They stretch for narrative. They stretch for status. They stretch for leverage. Then something breaks. Once something breaks, they discover what they actually owned. If what they owned required confidence, they lose confidence. If what they owned required liquidity, they lose liquidity. If what they owned required perfect conditions, they lose perfection. And if what they owned was bought at a price that left no room for error, they discover that price is not a detail. Price is the whole game. The prepared buyer behaves differently because he did not spend the boom years asking only what could go up. He spent them asking what would still matter if confidence cracked. That is the right question. It is the question underneath this entire story. What still matters? If the answer is a short government instrument with almost no duration risk, you keep ammunition. If the answer is a senior claim that survives the court process, you buy the right kind of debt. If the answer is productive land feeding people, you buy the right kind of ground. If the answer is finite scarcity beyond the printing press, you build a ledger of scarcity. If the answer is an ugly business whose customers cannot leave, you buy necessity. This is the identity flip most investors never make. They spend the expansion years trying to look smart. The prepared spend them trying to remain dangerous. That is the difference. The first man wants to be admired for being fully invested in the thing everybody is already talking about. The second man wants to be ready to buy what nobody wants to talk about yet. The first man confuses participation with preparation. The second man knows that preparation is what turns participation into wealth when the tide turns. So let me make this very practical. If you are serious about protecting and building wealth through the next major dislocation, you need a protocol, not a slogan, not a mood, not a social media posture, a protocol. Mine would read something like this. First, measure how much true ammunition you have. Not theoretical liquidity, not equity you hope you can sell calmly in a panic. Real dry powder. Short, safe, immediately deployable capital that does not need a heroic market to preserve its value. Second, examine where you sit in the capital structure of what you own. If everything you own lies at the bottom of the waterfall, you are relying on optimism more than you probably realize. Third, identify the difference between real assets and merely expensive assets. A real asset is anchored to necessity, scarcity, productive output, or durable contractual demand. An expensive asset is simply one other people have been trained to call high quality while paying too much for it. Fourth, build a watch list of necessities rather than a wish list of glamour. Which businesses remain unavoidable in contraction? Which categories consolidate when credit tightens? Which operators are underfinanced? Which leaders have the balance sheet to buy weakness? Fifth, decide your rules before fear arrives. What valuations interest you? What kinds of claims interest you? What proportions of liquidity you are willing to deploy as distress deepens? Fear makes improvisers stupid. Written rules make fear more tolerable. 6. Separate yourself. Image from your portfolio. This matters more than most people know. People hold losers in the wrong way because selling would force them to admit they never understood what they bought. People also miss great acquisitions because buying the ugly, the distressed, or the unfashionable would not flatter the image they built in better times. Vanity is one of the most expensive recurring line items in finance. Seventh, remember that a collapse is not only a decline in prices, it is a negotiation over who gets to own the future. If you think that way, you stop asking whether the next crash will feel scary. Of course it will. The better question is whether you arrive as forced inventory or as prepared demand. That is the final test. When the next siren sounds, will you be searching for explanations or opening the shopping list? That is not a rhetorical question. It is a contract with your future self. The middle class has been trained to think a crash is something that happens to it. The prepared understand that a crash is also the moment ownership gets redistributed. One group discovers what it cannot hold. The other group discovers what it can finally afford. I have spent enough time in markets to know that the script never looks obvious while it is being acted out. In the middle of a panic, every price move feels unprecedented. Every headline feels singular. Every commentator feels certain that this specific moment cannot be compared to anything before it. Then a few years pass, and everyone pretends the sequence was obvious. It was not obvious. It was structural. And if you understand structure, you do not need every detail to feel obvious in real time. You only need to know where serious money hides before the music stops. It hides in ammunition, it hides in priority of claim, it hides in calories, it hides in scarcity, it hides in necessity. That is the shopping list. The final choice is simpler than people want it to be. You can spend the late phase of the cycle proving you are optimistic, or you can spend it proving you will still have buying power when optimism breaks. One path feels better at the cocktail party. The other path changes the next decade of your life. I know which one I prefer. I know which one has built more enduring fortunes than every clever slogan ever invented on Wall Street. And I know this too. When the next real break arrives, people will once again say nobody could have seen it clearly. That will not be true. The shadows always arrive first. The question is whether you used the shadows to write the shopping list, or whether you waited for the siren and called that surprise.